Hello and welcome to today's FXTimes Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, March 31st, 2010. Let's begin with the euro-dollar pair, which saw a strong bounce following yesterday's decline after testing the 1.3540 area. We had buy orders at the 1.34 level, so that has set up as our new level of support. It was a 50% Fibonacci retracement of the rally that started on Friday and that moved to yesterday's high, as you can see here. And we did have a strong rebound following that test. So that's a positive sign for the euro, though it may face some stiff resistance now at this 135.50 area. Zooming this pair out slightly, we see that that level had acted as a consolidation zone during the pair's decline from 1.38 down to 1.3250. So that is the area we're testing now. So we could look for resistance throughout this range. The rise in the euro started during right at the beginning of the European session, and we had some positive data come out that favored the euro from Europe. From the Eurozone, we saw that inflation heated up in March as we had the flash CPI estimate and the annual rate rising to 1.5% from February's 0.9. That was much higher than expectations and could raise some eyebrows at the ECB, as recently we had a very timid consumer price inflation. On the downside, the Eurozone unemployment rate increased to 10% for the month of February, which was expected. However, if we take a look at Germany, we could see that the unemployment change there for the month of March, so a more timely indicator, fell by 31,000. So that was an increase of jobs of 31,000, which was much better than the 10,000 increase in unemployment expected. The unemployment rate notched down to 8% when it had expectations had it rising to 8.2%. So that's a positive development for the labor market in the Eurozone's largest economy. Taking a look at the euro-yen pair, we see that the euro has extended its rally that started around the 121.50 level about 6 sessions ago. In yesterday's trading, we peaked above the 125 area, which was an important level of resistance that we had seen during the middle of March and also in February, and in yesterday's trading we had peaked above it but fell back down below. In today's trading we had a much stronger move above that level, and we look set to close above it in today's trading. So our high as of 12 a.m. Eastern was at the 126.55 level. We now run up against resistance back here around the 127 level, which was a period of consolidation in late January, following a very sharp slide in January when we had the bulk of our worries over the Greek sovereign debt. We had been trading somewhat sideways throughout February and March, with some support around the 121 level, and we look set to be breaking out of this 2-month consolidation zone. We saw yen weakness throughout many currencies today. If we look at the dollar-yen pair, we had last week saw a big jump above the 91 area last Wednesday, but then we had a bit of consolidation to start this week. We had a bit of a triangle pattern as we had an upward sloping line of support and a downward sloping line of resistance that we breached in yesterday's trading, but then we were held up by our vertical resistance at the just below the 93 level. In today's trading, we moved above that horizontal resistance and we retested it as support following a weaker than expected ADP report. Jobs report from the U.S. However, the dollar managed to pair those losses rather quickly and is trading back at the level before that unexpected ADP result. Taking a look at that release, for the month of March, the private sector shed 23,000 jobs according to ADP, which was a very disappointing result as forecasts had called for a 40,000 increase. So that stayed very close to the declines in jobs we had seen in February. So you can see here we're not able to move above the 0 level. The goods producing sector declined by 51,000, but only 9,000 of that was part of manufacturing, as the bulk of job losses came from the construction sector. On the services side, we had an increase of 28,000 jobs. So this is our curtain opener for Friday's non-farm payroll report, which is expected to be show a much better reading, as there are other As the ADP figures do not incorporate weather-related rebound that could be present in the non-farm payroll report. In addition, the figure does not include any federal hiring in March for the 2010 census. So for both of those reasons, it's reasonable to expect that Friday's employment figures from the Bureau of Labor Statistics will be stronger than today's estimate in the ADP. Still, it's a bit of a worrisome sign that the labor market, at least from the private sector, is improving slower than expected. We had two more releases from the US. One was the Chicago PMI for the month of March, which showed the index receding to 58.8 from February's 62.6. While any reading above 50 signifies expansion, and so 58.8 is still a pretty strong sign, it was weaker than expected, though the main reading, which was new orders, remained right at their February level around 61.8. Employment also remained steady as it showed a 53.1 reading, which was very similar to what we had seen in February. In a final release, we had U.S. factory orders for the month of February, and it showed that the orders rose by 0.6%, which was better than expected, and we had January's reading revised higher to 2.5% from 1.7% originally reported. It was the 10th increase in orders out of the last 11 months and shows that the manufacturing sector continues to hum along. Excluding transportation orders, orders were up 0.7%, and excluding defense, orders were up 1%. So this shows that it was the core orders that helped the headline number. Also in the report, it showed that durable goods, which are designed to last for 3 years or more, were up 0.9%, which was higher than the preliminary reading that had those orders rising 0.5%. Also, an important sub-index within the report, which measures capital spending by businesses, the non-defense capital goods orders excluding airplanes, rose 2% in February, which clawed back some of the 4.4% decline we had seen the previous month. Taking a look at some of our other market highlights, we saw that the pound-dollar pair extended its rally that we had seen for the last 3 sessions as it tested the 1.52 level, which is an important level of resistance set out during this consolidation period we had seen in the pair. The pound also extended its gains against the yen as it pushed further higher after moving above this level of resistance around the 139 level in yesterday's trading. We did see a better than expected reading on GDP yesterday and some hawkish comments from the Bank of England, so that has translated into further pound gains in today's session. The yen, meanwhile, continues to be pressured on yield differentials and the outlook for longer term interest rates. Now, while our other higher yielders like the pound and euro rose in today's trading against the greenback, the Australian dollar-US dollar pair slid as we had some weaker data coming out of Australia. So that paired some of the gains we had seen in the rally that had started last Friday. If we plot a Fibonacci retracement, we see that today's support came around the 38.2% level. Decline in the Aussie comes even as gold prices rallied in today's trading as they moved to a new high this week after finding support at the 1,102 level, reaching 1,118. So here was the catalyst for Aussie weakness, which we had retail sales come out for February, and it showed a 1.4% decline on the month when expectations had it rising 0.3%. Building approvals, meanwhile, were down 3.3% in February when forecasts had a 2.2% rise. So the implication here is that the interest rates, the recent interest rate hikes by the RBA may be filtering down to the housing and consumption sectors. In our final pair, we have the US dollar Canadian dollar, and it fell in favor of the Canadian dollar as we did have some higher commodity prices overnight, and it reached a low of 1.0125 following the release of Canadian GDP, monthly GDP for January, which came in at 0.6%, which was slightly higher than expected. However, we did have a bounce in favor of the greenback as we had some risk aversion in early New York trading, but that has seemed to have faded as US equities paired their earlier losses, and we are now trading around the 1.0150 level as of 12 noon Eastern. Now let's take a look at our upcoming fundamental docket as we have some more news coming out of Australia, including the manufacturing PMI and a measure of inflation, as well as the trade balance. So another important day of Aussie fundamentals. From Japan, we get the Tenkan Manufacturing Index, which is a quarterly survey of confidence among large manufacturers and non-manufacturers. Overnight, Germany posts its retail sales, while Switzerland, the Eurozone, and the UK post data on their manufacturing sectors. In the US tomorrow, we get our weekly jobless claims, the ISM Manufacturing Index, a measure of construction spending, as well as motor vehicle sales for the month of March. And that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you good trading.